Chasing stock market rallies, that's one of those areas of trading that can be extremely, extremely dangerous for a trader. It's usually where the height of desperation meets the greatest level of FOMO, or the fear of missing out, where euphoria is at its peak. So many times in my trading over the years, I have found myself coming up short during the times where I tried to chase a major market rally that I didn't get into initially. And now we find ourselves again here where the S&P 500, over the course of just 2 weeks ago on a Monday, S&P 500 was gapping down almost 200 points to the downside. And then all of a sudden, it just went on this rip-roaring tear over the next 10 trading sessions. And that's where we find ourselves here. We saw SPY go as low as $510 a share. And now, 2 weeks later, it's trading at $559. Now, when I went cash in this market, it was around this area here that I was still trying to play that small cap everything else rally. I got a little bit out of that trade. It was like 1.5%, not nearly what I was hoping to get out of it, but I went cash at that point. I got knocked out on my trades. And then you had this subsequent market sell-off. Now, when the market sells off initially, I don't try to get in to the short side right away. What I want to look for is that dead cat bounce that takes us back to some kind of a level that's worth shorting at. So when we start to get that decline, what I then like to do is use an anchored VWAP off of the recent highs. So we got that. We got a one-day bounce, and then we had this huge watershed moment the next day. This was the area where I looked to get short at. It sold off for like 3 days. When I get a 200-point gap to the downside, I'm not going to look that gift in the eye and say, no, I'm not taking profits. No, I took all my profits. I closed out my position and went back to cash again. What I don't think I or anybody was really expecting at that point was the kind of rally that ensued. I mean, I don't think anybody was saying, hey, you know what, in 2 weeks, we're going to be about 1% away from challenging new all-time highs. In fact, if you look at it from a weekly chart, we're sitting right there at weekly new all-time closing highs. So we're pretty much right there at all-time highs. And when this market started the initial bounce, you had 2 days where the bears just remained in control. They were selling every attempt to rally this market. Those were cautionary signs. There was like, okay, the bears may still have this control of this market, but then you got this big candle here, and still I wasn't necessarily convinced that this was the time to go ahead and get long. But Tuesday of last week, we gapped higher and we blew right through this AV line. Not a big deal, because we see, just like what we saw here back on July 31st, you can get pushes above the AV line where it comes right back down again. And even with this 5-day rally above the AV, it still may come back down. But at this point, the temptation to run and chase after this market is high. I mean, you look at just today's candle alone, 559.61 was the closing price. The high of the day, 559.61. It's closing at the highs to the penny. So the FOMO is probably as high as it's been at any other point in this rally. But there's caution warranted in chasing after this kind of a rally. And I'll show you what I'm talking about here. We're up 8 straight days. That's an achievement in and of itself. You look at the stochastics down here on the bottom, we're sitting at a reading of 98, which is quite overbought. If you start to chase here, let's say we go in and get into the most hyped stock ever. NVIDIA, definitely the biggest large cap hype story I've ever seen. At $130, closed at the highs of the day just like SPY. If you don't think NVIDIA is absolutely dictating the movements on the S&P 500, you're crazy. I just mentioned that SPY closed at the highs of the day today. You want to know why? NVIDIA did the exact same thing. High of the day, 130. Closed at 130 to the penny. But let's just say we want to get into NVIDIA. It's rallied 40%. It's added $1 trillion in market cap just over the last 10 days almost. In fact, there's only 5 companies that are larger than the amount of market cap that NVIDIA has added to its value. It's added an entire Eli Lilly to its market cap. But let's just say, for the point of this, we're going to go ahead and get long on NVIDIA. You do that, we get long at 130 tomorrow. Let's say that this market has another couple of days of upside. Let's say it gets up to over the next couple of days to 133 before it has a pullback. If that pullback is even like 2 or 3%, let's say it's about a 3% pullback, and this stock pulls back 5%. That's probably going to take you out of the trade, even though you might have had some gains the first couple of days. You take something, maybe something more benign like Caterpillar, and let's say, hey, I'm going to play this breakout of this 3-day consolidation. You know, play the breakout of the three-day consolidation, and the market pulls back 2%, and you get 3 or 4% pullback in Caterpillar. There's a good chance you're going to be stopped out. There's going to be no reason to be in it. So the point here that I'm trying to make is that when you go back to SPY, yes, it seems very tempting. You feel stupid for not getting into it. I didn't get into it. And I don't mind saying it. I've missed rallies in the past. I'll miss rallies in the future. I've missed sell-offs in the past. I'll miss sell-offs in the future. But I've also captured a lot of rallies, and I've caught a lot of sell-offs as well. As a swing trader, over the course of your career, you're not going to get into every rally. You're not going to get into every sell-off. You're just not going to be able to capitalize on every gain if you're being prudent and trying to manage risk. So sure, there's people that will react to every candle there is. But if you try to do that yourself, you're going to find yourself oftentimes running amok on your risk reward. You're going to be looking at a lot of red in your portfolio and not much green. So I'm not chasing this, but what would get me to get back into this? Let's say we're not pulling back. You go back to 2014. This is a good, probably one of the best examples of what I've seen and similarities to this current rally that we're undergoing here. We'll pull it up on the weekly chart. We had back in 2014 a pretty heavy sell-off. We went from the highs, all-time highs back then of 201 all the way down to 182. Pretty big. That's about a 10% pullback right there. And then you had this monstrous candle that came in. This happened on a week that everything looked like it was falling apart, but it didn't. It actually went back into the green. And for 8 weeks thereafter, it continued to rally. The first 3 weeks were the biggest, and then the candles got a lot smaller. But during that time, it rallied about 14% off of these lows. That's a massive, massive rally. Now, in the grand scheme of things, you can see where it wasn't very easy thereafter. All of 2015, and I've often referenced 2015 as being one of the most difficult trading markets that I've ever traded. So we're talking about a little bit of market history here. You ended up getting an incredible run off of these major lows right here that was formed. But you can see as we got closer to a top back in 2014, the volatility started picking up quite a bit. Now, it still had a little bit of a breakout, a 3-week period that you could have made some profits off of back then. And so you got to let the consolidation come about, because at the end of this rally, we were sitting at a stochastics reading of 98, and just like what we are right now. And then it finally started to consolidate, and all the way down on the bottom here, the stochastics came right back down to 23. So fast forward to today, we're sitting here after 8 straight days to the upside. You're looking at it from a weekly, 3 straight weeks to the upside here, right back up to all-time highs. I'm not saying it's going to perfectly mirror what we saw in 2014, but it's a good analog to look at. Now you go back to 2022. Here's the flip side of it. We stick an anchored VWAP on the highs going back to 2022. We blew right through this VWAP here, just like what we did right here. And then eventually it did come back down. So the weekly does provide a little bit better perspective. But if you take this declining trend line here, you can see it's not quite the same slope. It's a little bit pushing through that level right there. So it's getting a little bit more out of hand than the rally that we saw back in 2022. Doesn't mean that it has to have the same slope. I'm just trying to give it to you from a historical perspective. If we take out the all-time highs, all the bets are off. There's no downtrend at that point intact. The bears will have essentially lost any kind of edge that they might have still been holding on to at that time. And right now, it's very, very faint. But what we have to make sure is that we're not chasing rallies at their peaks before we might get a 3 or 4% pullback, or even worse, maybe we do come right back down and test these bottoms. That could still happen. And if you're buying in right here, there's a good chance that you sold right here. And you don't want to be in that boat where you're buying when you should be selling and selling when you should be buying. Instead, what you really want to be doing is waiting for a little bit more of a calmer period to take place. Down here, you got very, very light volume that's guiding this market to the upside. You want to see it consolidate some. And then you try to take advantage of a secondary breakout. Missing out on this, if this market's ultimately going to much bigger all-time highs, this doesn't really matter, because this is just the beginning if that is the case. You want to get the meat and potatoes. You want to get that middle chunk of the rally. If we miss out on this, but we still are able to get in on the remaining parts of the rally, that's great. If we can stay for dessert, even better. But we don't want to go chasing them at this level without there being some kind of consolidation, without there being some kind of reset of the reward risk factor, because right now this shows nothing but lots of risk and little reward here at this point in time. If you enjoyed this video, I would encourage you to like and subscribe. Make sure you click the little bell notification so that you can be alerted to anytime I make a new video. Plus, tell me down in the comments below, did you get in on this rally at the lows? Did you get in at last Monday? I'm sure there's a lot of people out there that's wanting to claim that. Congrats if you did. What's your plan now? Are you going to continue to hold, or are you starting to book profits here? Love to hear from you guys. Thank you guys, and God bless.